The largest disruptions in Indian equity markets throughout history have been because of factors which have nothing to do with India.
I've also seen this one thing that 85% of the US dollars, I don't know if this data is true.
Is created in the last 5 years.
Is created. Is that true?
Yeah, it's true.
My.
It's true. Accepted now is they kept the money printing press on for a bit too long.
Indian rupee is falling more than the US dollar.
Yeah.
Indian rupee is depreciating more than the US dollar.
Yeah. Apart from gold, the safe asset is a US government bond.
But do you think Trump wants to devalue the dollar deliberately?
April 2015 to April 2020. Your return of a 5-year SIP was negative 5.82%.
Is the recession inevitable? So today we are hosting a podcast with Mr.Indraanil Guha. He has started Alpha Plus SIPs and he personally believes his personal SIPs, the way he does it, is way better than the conventional, the normal SIPs. So why is that the case with Alpha Plus SIPs? Why does he think that his SIPs are better? And what does he think about the US economy, labor market, and the liquidity stage in the whole world right now? Please welcome Indraanil Guha once again. Thank
Thank you,
please.
Ronnie.
Yes.
Thank you.
So, Mr. Indraanil Guha, please introduce yourself. Tell us about how your career started, how this, how you entered the market, how macro was a very important story for you. So, please introduce yourself.
Thanks, Ronnie. Thanks for the invitation. Lovely podcast you've been running for a while. I've been following your podcast
Well,
for
trying my
some
best.
time now.
Trying my best.
But great work so far. So I run, as you mentioned, a macro-driven hedge fund. The platform that I run is called Metacaps.ai.
Okay.
As part of that, our primary offering to our customers is something called AlphaSIP, which, as probably later on in the
podcast
discussion, we'll discuss more about how it's distinctly different from a conventional SIP. But a little bit about myself. In terms of my undergraduate background, I'm a computer science engineer. I went to a college called NTU, Nanyang Technological University, which is in Singapore, almost 25 years back. Worked there after my studies for a couple of years. So cumulatively almost 7 to 8 years in Singapore. Then I came back to India for.
So what were you doing in Singapore exactly? So it
So
was
for-
something related to computer set?
Yeah, I
I
was I did consulting for about 3 years after my job. In fact, so I availed a scholarship given by Government of Singapore to finish my studies, and one of the conditions that they had was in lieu of which I got the scholarship was that I should stay back in Singapore, because the scholarship is basically a sort of a talent top-up program of the Government of Singapore, as part of which they bring in talented individuals from countries like India, China, Malaysia, Indonesia, and I was one of the lucky few to get through. So their requirement was to stay back and work in Singapore for at least 3 years after you finish your studies. So I finished my that 3-year requirement, and in 2007 I came back to India for my MBA. That was in Bangalore. And 2 years of MBA. I got out in March of 2009, probably the worst time to get out of an MBA in recent times.
After the Lehman Brothers.
We sat for our placements 6 months after the Lehman collapse. Lehman collapse was, by the way, September of 2008. And 2009 March is when we sat for our placements. A terrible time to get out of. Even the top IIMs were struggling to
get placed in the job.
Place the entire batch, right? So it was so bad. I remember in our previous batch we had, so the most coveted jobs are the ones which are on offer on the so-called day zero, which is the first day of placements, right? We had in those days the batch size used to be smaller, about 250 in Bangalore. About 80 people got through. 80 out of 250 got placed in day zero in our previous batch, in the 2008 batch.
Got it.
In my year, 2009, 13 people.
13 people.
13.
The comparison, how much did it go down by? Nearly 70-80%?
Yeah. So 80 people, if you're down to 13, I remember this number 13. Because
85%.
So I was the 13th guy out on the placement. So it worked out, thankfully, not so badly for me, but overall for the batch, it was pretty bad. And that in a way, it leaves scars for you, which makes for muscle memory. I mean, you also asked what's the genesis of something like AlphaSIP, right?
Yeah.
I think it started from there.
So basically, because of this whole thing that happened in that is how you entered into the stock market.
So I didn't immediately get started in stock market professionally. I'm trained in finance. So my MBA was with a focus in finance. But as I said, I got out in a year in which finance jobs were down to zero. Investment banks didn't turn up in 2009, right? Only consulting companies were the ones which turned up on day zero. I started my post-MBA career with Accenture's management consulting practice. So they have management consulting practice. In those times, it was management consulting in Accenture was based out of Delhi and Bombay. So I joined their Bombay practice, and I have worked for clients all over South Asia, India as well as South Asia, Bangladesh, Sri Lanka, India.
That is how you.
Yeah, so pretty wide-ranging experience across in consulting for a few years, and then eventually in 2016, I finally decided to quit and start my own venture, which is when I decided to go back to my true calling, which was to do something in the world of investing in finance.
Yeah, stock market.
Yeah.
Basically.
Yeah.
So your Alpha SIPs are particularly focused towards macro analysis.
Yeah.
I read on your LinkedIn, you said that you want to build your own first macro-driven hedge fund in India.
Yeah.
And there is not one right now, I personally feel.
Yeah.
Why? Yeah. Because why macro-driven? What is the importance of it? Yeah. And for a retail investor, how important this macro analysis should be before investing? Yeah. If you can help me out with that.
Very, very good question, Rohit. See, as I said, I came into the world of finance post my MBA at a time when the world was literally falling apart.
Almost like a great depression.
Closest to the 1929 kind of a situation that the world had come to. Everything was falling apart, right? Yeah. And the Nifty had crashed 60%. That's like the worst crash till then in the history of the Nifty. Even today, that continues to remain the worst crash in the history of the Nifty. And that set me thinking that, here we are sitting in India, looking at our companies and the destiny of our market only through the lens of what is happening within India in our economy, what is the earnings growth of our companies likely to be over the next couple of quarters. And the entire analyst community's thought process was driven by factors which are very, very internal to India, as if that is what exclusively impacts our markets and the destiny of the stocks of our companies. Yeah. And yet, somebody like me who came into the world of finance in 2008, 2009, for me it was the first thing that I could not ignore is that the largest disruptions in Indian equity markets throughout history have been because of factors which have nothing to do with India. Right? 2008 100%. Happened because 100%. Of the subprime crisis in the US and culminated in the form of Lehman Brothers going bust. Lehman Brothers, for all its heft and influence, had zero presence in India. A couple of
nobody in India took any loans from
in India took any loans. Lehman Brothers didn't have any branches in India. There were no Indian assets which went bust because of Lehman going bust, except for a couple of bright graduates from IIMs that Lehman and their likes would hire. There was very little connection between India and Lehman. So why would Lehman going bust cause a 60% correction in India, right? And it was not just an isolated case of what happened in 2008. I mean, look at all the large drawdowns that we have had in this century. The prior to 2008 was the dot-com bubble burst of 99-2000. That happened because you had a dot-com bubble burst in the US, and the Nasdaq went down 86%.
Yeah.
But why should Amazon and tech majors in US going down 80-90%? Why should that in India we got a 51% correction because of that between 99 and 2000?
I feel if something happens in the US, the US sneezes and everyone else catches
a cold.
Yes,
right?
that's what the basic saying is.
Correct.
Yep.
So I see, for me, so it was so nobody will dispute that fact. And yet somehow that was, even today, I believe that is not yet part of the overall, thought process of the analyst community. Even though everybody knows that when the US sneezes, the rest of the world catches a cold. So I thought that this is a white space which needs to be filled. That if indeed the US sneezes and rest of the world catches cold, you need to build empirical models which can establish the link between if the US sneezes, to what extent rest of the world is going to catch a cold.
Yeah. So if you're sitting in India, you need to know about the US markets.
Not only do you need to know about the US market, you need to have empirical models which can create linkages between, if there is a certain amount of disruption that is happening in the US bond market, to what extent that is likely to have an impact on Indian equity markets.
Yes,
right.
Definitely.
It cannot be a sort of a very superfluous, subjective linkage that we all know does exist, but we can't quantify. It has to be a quantifiable linkage between the two. And that's where I thought that, that's what we took it upon ourselves to build. That an empirical study which can establish a very numerical link between what's happening in the US financial system, especially in the bond market, and its impact on the US market.
People don't realize the importance of the bond market. Things like yield curve, inverted yield curve, which we will talk about as we go on. So let's talk about the US economy. Like you said, we talked about that if US sneezes, everyone catches a cold. Let's talk about US.
Yeah.
So US, debt, everything else. Let's first start with interest rates.
Yeah.
So labor market is pretty much bad. It has been, showing signs that it needs an interest rate cuts just so it gets better. Yeah. But on the other side, inflation says it doesn't need it doesn't need an interest rate cut at all. Retail sales are high. Basic CPI, core CPI is pretty much decent. I won't say really high, but it's pretty much decent. It doesn't need a rate cut as of now. And with Fed now saying they have cut rates a month ago, they're going to do it again, most probably in the 2 more times as the year goes on. What do you think about this? Can this whole situation lead us to something like stagflation? If not like stagflation, what do you think about the whole scenario that is going on with the labor market, inflation, and the confusion between the Fed? I know it was a very long question.
But I think it's important to talk about it. But I would, the way I look at this, Ronit, I want to take a slightly broader view of this instead of just the last couple of quarters. Let's look at it over a post-pandemic view of what has happened since the pandemic broke out, right? The pandemic broke out, that led to a very depression-like scenario. Inflation went to pretty much zero, right? And in turn, the Fed started money printing in order to support the US economy and the US financial system. And slowly the Fed was able to engineer a revival of the economy as well as the markets, right?
Yes.
But I think where the Fed erred, quite almost universally acknowledged, accepted now, is they kept the money printing press on for a bit too long.
Yes, right? Definitely.
To give you a context, after 2008 also they did money printing. So the post-COVID money printing was the second time that the Fed was resorting to this.
Extreme.
So how extreme? I'll give you a sense of that. The Fed balance sheet post-2008, money printing started in March of 2009. It went on till about, I think, early 2015.
Yeah.
6 years, the Fed printed $3.5 trillion. The Fed balance sheet went from $1 trillion to $4.5 trillion, $3.5 trillion worth of money printing.
And in 2020 itself.
Post-COVID, they started printing money on 23rd March 2020. In the next 2 years, they printed $5 trillion. 2 years.
Compared to 6 years,
3.5
6
trillion.
years, 3.5, and 2 years. I've also seen this one thing that 85% of the US dollars, I don't know if this data is true.
Is created in the last 5 years.
Is created. Is that true?
Yeah, it's true. It's true. It's
Seriously.
True. Yeah, look at this way. The Fed balance sheet, this is the amount of money that they have created.
Yeah.
Something even more startling. The Federal Reserve as an institution came into existence in 1913.
Yeah.
Okay. Money printing, quantitative easing as a intervention tool was first tried in US in 2009, right? Yeah. Which is in the 95th or 96th year of the Fed's existence.
Yes. Okay.
Right? 95th, at that time, the Fed's balance sheet size. So it took almost 96 years for the Fed balance sheet to come to 1 trillion.
Yeah.
In next 6 years, Fed balance sheet size goes to $4.5 trillion.
And now?
And
in
today,
2025?
So it went to, at the height of COVID, it went to $9 trillion. So 4.5, another $5 trillion, it went to 9. Since then, we have been having QT, quantitative tightening. So Fed has been pulling out liquidity. They realized they printed too much. Yeah. So now it has come down under 7 trillion. Yeah. So it's slightly lower than its peak. But to just imagine, 95, 96 years you took to get to a balance sheet size of $1 trillion. In next 4 years, you go to 4.5. Yeah. And then in COVID, another 2 years, you go to $9 trillion. Yeah. So you're right. In the last 5 years, the amount of money creation has been 85%. But to come back to your question of where we are in the overall state of the economy. So the amount of money printing was so gargantuan this time round. And see, last time in 2008, there was a difference also in the sense that in 2008, the money printing was done in order to bail out the banks which had given out these bad loans. This money did not really go into the real economy. Yeah. This time round, what happened? All this money printing that happened, this money went to the government first, and then the government gave out, this money was given out as cash handouts to individuals. People there
you go, you take $100.
In the bank account, people got money, right? Yeah. And so if you get money in your bank account, that money is going to be spent on the store. Yeah. In the real economy, people will go and spend it on restaurants and malls and stuff. Yeah. That's how the money goes into the real economy. If you create new money and you bail out a bank, that money doesn't go into the real economy. That doesn't cause inflation. That's why post 2008 you never got inflation. Post 2020, this newly created money actually went to the retail level into the bank accounts of people. Straight away. Yeah. So and in the form of outright grants, right? So and got spent, right? Yeah. And that's why by June of 2022 you had inflation going up to 9.1% in US, right? For the first time in my lifetime, you had inflation in US being higher than inflation in
It was India. For a quarter, for a month, this 9.
So that every month you have a monthly reading.
Yes.
So 9.1 was June of 2022. Okay. Right? At a time when, so usually developing countries have, for the last...
Like India, like 7, 8.
So in US-led developed countries usually have inflation in the range of 1 to 2%. This is what we have been trained to, believe. And developing countries like India typically have inflation in the range of 5, 6, 7%, right? Okay, yeah. For the first time in my lifetime, it got flipped. We had India inflation at the peak of COVID, it went to about 7%. US inflation went to 9.1%, right?
Even if it was for a month.
So it gradually was increasing. It finally peaked at 9.1%.
Was it like a month before it was at 6 and then it went to 9?
It gradually went up.
Right? It went from 6 to 7 to 8 to 9.
Yeah. So and it was entirely because all this while this is what the Fed is now criticized for, is that while this was going up, it isn't as if that it was a step jump from 2 to 3 straight away to 9. It went up quite gradually and in plain sight. And all that while the Fed believed that this inflation is, in Fed's word, the word they used was transitory, right? Yeah. So they believed that it's because ports in China are operating at low capacity. That's why goods are not being able to come in. Factories are not operating at full capacity. So this whole shortage that is being created is a very temporary phenomena, and as the COVID situation resolves itself, factories go back to their full capacity, ports go back to their full capacity, supply situation is restored, they believe that this inflation will come back, right? Completely ignoring the fact that not only was there supply constraint because of factories operating at low suboptimal capacity, because of the money printing and the money being given out into the accounts of people,
it did a double down.
You are putting demand on fire, right? You're putting demand on fire at a time when supply is constrained, right? And this part they totally underestimated, and the twin impact of this was the 9.1% inflation that we got. And by the time the Fed realized it's so they were very late in withdrawing the money, the QE, and they should have stopped money printing sometime in early 2021 and started raising interest rates much earlier. But they finally started doing that only in January of 2022. It was very late by then. And I think, so we got a big spike, and that's in inflation. Inflation went all the way up to 9.1%, as I mentioned. But now that the Fed also realized that they were late, they had to press the brakes very, very hard, right? So interest
they raised the interest rates.
What we got from January 2022, interest rates went from practically 0 to 5% plus levels.
Yeah, 5.5.
Yeah. So that's the steepest in a matter of just 1 year.
Yeah.
Right. That's the steepest increase in interest rates in Fed's history.
Yeah. That is why Nasdaq and
Dow,
S&P were down, and Indian market was consolidating at that point.
So we had a pretty, 2022 was all over the world. It was late 2021 till middle of 2022. India, we got about a 17% correction. US was about 20% correction. So the direct impact of the Fed slamming its brakes.
What about the current situation? Sorry, I'm cutting you off, but what about the current situation now?
So we have to look at the inflation in the context of what was happening since then. So from there, from an inflation of practically 0, you went to an inflation of 9.1%. And from 9.1%, because of these super high interest rates, inflation started to gradually come down.
Decline.
And inflation actually did come down to about 2.7, 2.8 kind of a handle. So from a 9 handle, you come down to a 2 handle, which is a remarkable decrease in inflation. Now, because of tariffs, what I want you and your audience to appreciate here is we have had the single largest quantum leap in tariff imposition since the 1920s.
What do you mean by quantum leap?
So US weighted average tariffs were sub 2%.
Yeah.
They have gone up to 15% plus now.
Yeah.
Right? The last time we had double-digit effective tariff rate was in the 1920s, right?
Okay.
Such a steep tariff increase, and inflation has gone up from barely 2.7, 2.8 to current core inflation is 3.1. That doesn't seem like a quantum leap in inflation. Right.
Yeah.
So what I'm trying to address your question of stagflation, I know that's the popular opinion that we are heading towards that, but I believe that the US economy right now is in such a weak spot. Basically, what is happening is that if you have been following the labor market, I keep talking about the labor market in my own YouTube channel very, very strongly. The US economy is, especially if you look at it through the lens of the US labor market, is now slow. The labor market is in complete collapse in my view.
Yeah.
So to give you a context, in the first 4 months of the year, January to April, new job creation numbers were consistently above 100,000 jobs per month.
Yeah.
More than 1 lakh jobs were consistently getting created. From May onwards, that 1 lakh has now fallen to May and June. It fell to 19,000 and 14,000.
Okay.
80% drop.
A drastic
drop, right? And then the June numbers have now been further revised down to negative 19,000.
So those numbers are now revised down to negative.
Now, yes.
So there was basically no job creation in.
So now now net job creation has become minus. So you are now in net job loss territory, right? So this is if you look at the labor market, there is clear sign of distress. This is very, and the other number that you must focus on is the unemployment rate. Consistent with this drop in new job creation, we have had a consistent upswing in unemployment rate. April 2023, unemployment rate fell to a cycle low of 3.4%. Since then, unemployment rate has consistently gone up. Today, it is at 4.3%, which is the highest level in last 4 years, and the trend is looking towards the upside. Now, when you are in a situation where the labor market is in such a massive distress, people are losing jobs. I personally don't think that inflation can be a very big risk, because in such a
but then Fed Jerome Powell, the Fed chairman, he is saying that inflation is his worry, and other things are his worry. Does he fear that if he makes, a mistake again, like, cutting the interest rates too fast and too low, like he did in 2020, is it going to result in kind of the same thing as high inflation, or like a scenario like soft landing or hard landing kind of situation, in which definitely hard landing seems inevitable? Is this what Jerome Powell is fearing?
Yeah, so I don't want to be in his shoes. He's in a very, very, very tough spot. So if I should give you a context of what the Fed is supposed to do, Fed has two mandates. The Federal Reserve Act, which brought the Fed into existence, created two mandates for the Fed. This is what the Fed is supposed to achieve for the US economy. Price stability, which is a technical term for keeping inflation under control.
Yes.
And the second thing is maximum employment, which is basically to maximize the employment in the economy.
Yes.
Now, these two things often are at odds.
Yeah.
Right now, you are in a situation where the labor market is weakening, which requires the Fed to reduce interest rates in order to support the labor market.
Yes.
But the inflation tendency because of the tariff situation is towards the upside. Inflation pressures are towards the upside, which would otherwise require the Fed to increase rates. So the two mandates that the Fed has requires the Fed to act differently, right?
Okay.
And that's why the Fed has to make very tough choices. And all the way till as recently as July of, so the most recent meeting of the Federal Reserve was in September of 2025, which is when the Fed cut Fed funds rate by 25 basis points. Prior to that, the last meeting was in July of 2025. Till July of 2025, the Fed's position was, till that time, this labor market, the revised numbers of the labor market that I just talked about, the new job creation, monthly job creation numbers fell from 1 lakh plus per month to about 19,000 per month. These numbers were not out yet.
Okay.
As recently as July, the Fed's position was that the labor market is still sufficiently strong, so their focus was inflation, and that's why.
Sorry, I'm cutting you, but then he came out with the dovish tone in August or September.
And then these new numbers came out, which showed that the labor market is collapsing, and that's why from July, where the guidance that they gave is that they don't foresee rate cuts to restart in 2025. In the very next meeting, they are not just cutting Fed funds rate by 25 basis points. They have also indicated that there are two more meetings lined up for 2025. They are likely to cut in those two meetings as well. Because now they believe that between inflation and labor market weakness, the labor market weakness is something which is far more serious than the inflation situation.
So he's in a tough spot.
Yeah, he's in a very tough spot. But I think in his shoes, he's right. Between the two, the labor market, the risk of not cutting at this stage would imperil the labor market situation far more than the inflation situation. Because I don't think at this stage the inflation can really spiral out of control given the job market dynamics that we have.
Actually, because these things are kind of
very correlated. Very correlated.
Yep. Yeah. Coming on to the next question, let's talk about something very very interesting for me personally. That is the US debt.
Yeah.
So US debt is nearly $38 trillion. They have a lot of refinancing to be done. They have to repay a lot of debt. We are hearing all of this news. You said Jerome Powell is in a tough spot. I feel he's in a tougher spot because Trump is pressurizing him to cut interest rates as fast as possible and as much as possible. because he wants the interest rates to go down and the yields of the bonds to come down, because whenever the interest rates go down, the yields on the bonds go down. But the recent rate cut that happened, when the rate cut happened, the bond yields didn't go down. Rather, it went up. So, is that alarming? Is that thing really, really alarming for the economy?
Very good question, yeah. And probably I'll share a chart with you, which you can also share with your audience to go along with what I'm going to explain.
Yeah, don't worry, it will be shown up in the screen.
So I've talked about this in my own channel as well. Try to understand it this way. There are two interest rates we are talking about here. One is the Fed funds rate, which the Fed controls. Fed funds rate is basically the overnight lending rate. If it's a notional rate, if there was a government bond whose duration is 1 day, then the interest rate on that is Fed funds rate. There is no actual bond of one day, but it's the notional rate on a government bond of 1 day. It's basically the overnight lending rate. And when you say the bond market rate, you're basically talking about the US government 10-year bond.
Got it.
Right? When you invest in a US government 10-year bond, you are essentially giving loan to the US government for a duration of 10 years. Right? And the interest rate that you are charged, that the US government is going to pay you for investing in a US government 10-year bond is what is called US government 10-year bond yield. Right?
Yes.
Normally, in case of bonds, the way this works is whenever you give a loan to somebody, the interest rate that you get in lieu of that loan is a function of the risk of default. Higher the risk of default, higher is the yield, interest rate that you will get.
It's just like if I'm coming to you and I am in need of debt and nobody is lending me money, I will say I will give you a 10% rather than 8.
Correct. So if there are two people with one person with a CIBIL score of 600 and another with 750, the 750 guy gets a lower rate, right?
Yes, because he is more trustable.
More creditworthy.
Yes.
Right?
So whenever you're less credible, you have to pay more interest.
Correct. Now even for the same person, there is another factor which impacts yield, which is the duration of the loan.
Yes.
Even
100%.
for the same person with somebody with a CIBIL score of 750, the risk of a default increases depending on whether you're lending him money for 1 year or lending him money for 10 years.
Yes.
The risk that he may lose his job, he may be in bad health, because of which he may not be able to service his debt obligation. These risks are significantly higher 10 years down the line compared to 1 year down the line, right? So that's why the interest rates are higher on a 10-year bond, and a bond is nothing but a loan to the government, right? And that's why in case of bonds, as the duration of the bond keeps on increasing, the interest rate on the bond also keeps on increasing, even though the borrower is the same. It's the government, right?
Okay.
If you think about it, the same thing applies even at a retail level. You go to do a FD with a bank, you are effectively giving a loan to the bank.
Yes.
But a FD is typically of 1 to 2 years. That's why the bank gives you interest of 7 to 8%. You go to the bank to take a home loan for 20 years or 30 years, the bank will give you the same money for 9 to 10%. Right? Because the duration
has increased.
Right? So the same thing happens in case of bond market also. Bond market ke case mein, the overnight lending rate is a bond yield for one night ka bond, and a 10-year bond yield is the US government 10-year bond yield. Right?
Okay.
Fed controls the shorter end of this is basically the yield curve. For every duration ka US government bond, what is the yield? If you plot it on a map and you join the dots, that's what the yield curve is.
Yes,
right?
Don't worry, it's going to be up here.
So I'll share the current yield curve. So the shorter end of the yield curve, which is the overnight lending rate, is controlled by the Fed.
Yes.
And the farthest end, 10-year, 20-year, there are even 30-year US government bonds.
Yes. These are controlled by supply demand.
They are actually controlled by the bond market participants based on their perception of inflation in future.
Like in perception about the economy, how well they're going to do as well.
So even more specifically within the economy, the singular factor which the bond market looks at is inflation. If they view that going forward, inflation is likely to go, if they believe that going forward there's going to be a recession and inflation is going to crash, inflation basically usually comes down during a recession. 10-year bond yields will come down. If they believe that going forward because of tariffs, inflation will go up, 10-year bond yields will start to go up, right? Shorter end, the Fed controls the bond yields, right? Now
Now tell me what happened.
Now what happens is that typically the president can force the Fed to lower interest rates.
Can he?
So,
but I feel like they're two separate bodies. But definitely Trump has kind of made sure that they are not separate. Like he fired Fed governor.
So that has been overturned by the court. So he has tried. So far at least the institutions have been able to hold up pretty well.
Yes.
But even
somehow,
but even without, let's set aside the factor whether Trump does have sufficient influence on Jerome
but he's
Powell
at least pressuring.
He's pressuring him for sure.
Definitely.
Right? But the Fed on its own volition has already lowered interest rates once, and they have also indicated that they are going to cut Fed funds rate by 25 basis points twice in the rest of the year. If that happens, then this year itself, between September and December, we'll get 25 into 3, 75 basis points worth of cuts within a 3 months.
That is good.
That's a big cut.
Yeah, that is a big cut. That is aggressive, kind of.
Now I'll tell you what happens in this. And for this, I need to go back to what happened last year. September 2024 is when the Fed started this rate cut cycle in the current business cycle, right? From about 5.5%. The first cut itself was of 50 basis points. Usually they cut in by 25 basis points in one cycle.
The first one was
first
50.
itself was 50 basis points. And then they followed it up with 25 more. So September 24 to December 24, we got in 3 months, we got 100 basis points worth of cuts.
1% cut.
1% cut, 100, right? 25 basis points is 0.25%, right?
Yes.
Now, normally what happens is that if the Fed believes that the economy is weakening and Fed is cutting, and the bond market also believes that the economy is headed into a recession, so 10-year bond yields will also come down and Fed funds rate are also coming down. If both of them are coming down in tandem, that's usually a very good sign for the economy, for the equity market. During such times, equity markets do very well, right? Last year in September of 2024, before the Fed started, usually the bond market is more efficient in sensing that the economy is slowing down, and that's why that's why you will see that usually before the Fed starts to cut, after sensing that the economy is slowing down, the bond market has already started. The US government 10-year bond yields usually start to come down much earlier than that. Last year, September 2024, the Fed started to cut. Almost 3 to 4 months before that itself, 10-year bond yields had started to come down, right? And then in September 2024, the Fed came in and they realized that, wow, the economy is like in a bad deep shit
spot,
now. And they cut by 50 basis points one shot.
Yes.
And then they followed it up with
25.
So total 100 basis points. Now, this is slightly counterintuitive. The bond market also believes that the economy is slowing down. That's why the US government 10-year bond yields were coming down all the way up to September 2024. But now Fed comes in and Fed overreacts and cuts by 100 basis points in 3 months. Right? What that leads to is a situation where the bond market starts to fear that yes, the economy is slowing down, but the Fed is probably overreacting by cutting too much too soon? And because it's a very fine balance you have to do. Yes, the economy is slowing down, you have to cut. But if you cut too much, then it's an economy which is slowing down, but it's still a positively growing economy. And an economy which is growing, even if at a slower pace, if the interest rates come down too much, then you are stoking demand. Because then interest rates are becoming cheaper. Then you are encouraging more people to take cheap loans and go and spend on cars and houses and other consumption items. And that can stoke inflation. So if in a slowing economy, if rates are coming down more than what is warranted, in the view of the debt market.
More than what it is wanted.
Then it creates inflation fears amongst the bond market participants. So
Which
what
is
happened?
why-
So which is what happened is after September 2024 till September, as the Fed started to cut, 10-year bond yields which were actually coming down before September of 2024, after September 2024 they started to shoot up.
Yep.
So 10-year bond yields were at
Opposite effect.
opposite. So now they are at cross currents.
Yep.
US government 10-year. So I think we should have those charts in
Yeah,
on the
don't
screen.
worry, don't
So
worry,
US
don't
government 10-year bond yields in September 2024 were at 3.6%. Over the next couple of months, they went all the way up to
4.1.
4.8, 4.9.
Oh, okay.
Right. So since then they have come down to about the
4.1.
current level of 4.2. It went all the way up to 4.9%, close to almost hit 5. 30-year bond yields went above 5%. Right. So 10-year bond yields going up, Fed funds rate coming down.
Yep.
So
Explain. Sorry, I'm cutting you off. You said it's bad for the thing. I also personally believe, but I cannot explain it. But I hope you can explain it to a basic retail investor. How is it bad for the equity market?
So you can see this if you look at it through the lens of the chart that we should have on the screen, have alongside this, is whenever you have Fed funds rate coming down,
Yes.
but 10-year bond yields going up, they are in opposite direction. You can see that after last year September, the Nifty corrected by about 16%.
Yep.
Right.
Yep.
So that's after so 10-year bond yields went up to about 4.9 by about, I think by February they had February of January, February of 2025 they had peaked to 4.8, and since then 10-year bond yields started to come down. So as Fed funds rate, the 10-year bond yields started to come down again, then again we got the rebound in Nifty.
Yes.
Right?
Yes.
Now that's the risk that I want your audience to be aware of. Okay. Now we are again in a repeat of what happened in September of 2024.
Again.
September 2025, the labor market is in a very weak spot.
Yeah.
The Fed could see that the labor market is in a weak spot almost 3 to 4 months before the Fed started to cut.
Yeah.
So from June, July itself, 10-year bond yields had, in fact, from the beginning of the year, it went, as I said, it went to 4.8. Currently, Fed funds rate is at about 4.2-ish, right? So we got a 60 basis point cut in a drop in 10-year bond yields because the bond market could already foresee that the labor market is moving towards weakness, right? Fed woke up to this only in September of 2025.
Yeah.
And Fed has now cut by 25 basis points, and they have again indicated there is 2 more cuts lying ahead in this year. 75 basis points, not in 3 months. Not as aggressive as last year, but aggressive nonetheless.
Yeah.
If
like it's fair enough like it's not exactly aggressive,
but aggressive, at least moderately aggressive.
Yes,
right?
Yes.
And so I'm not saying it's bound to happen, but it can lead to a situation of last year where of the sort of disconnect that we got between Fed funds rate, which was going down, and bond yields, which were 10-year bond yields, which were shooting up. If that were to happen, then we can get another sort of a interim pullback,
like we experienced last year.
Again, having said that, I don't want to paint a very doomsday picture. Last year we got a 16% correction. As I said, the quantum of the disconnect this year is not as much as last year. So even if we get a pullback from these levels because of this disconnect, I don't think it will be even remotely as close to 16% that we got last year. But that risk is something that we need to be aware of. That if
there is this risk.
So bond yields, if they aggressively start to shoot up from here, US government 10-year bond yields, then we have to be careful that can have an effect on equity market.
So basically what happens here is basic institutions will go like, we're now investing in bonds instead of equities because we are getting good yields.
Correct. Yeah. So anything, if the bond yields going up, you are basically creating opportunity. So bond yield
for institutions to shift there.
So risk capital moves to US government bonds. Basically.
Perfect. Yeah. So let's come on to the next question.
Sure.
As of January 2025 data, US needs to pay back nearly $28 trillion by 2028. $9.2 trillion within this year, which they've done. And in coming years, again, $19 trillion, near 19. US is not the safest asset anymore. This is what we can, see through central bank, how they're deploying their money. They used to invest in US bonds thinking it is like, the safest asset. How this decade has started until now, people are slowly and steadily, especially China, Russia, and now India has also stepped into this thing. They're buying gold now. They're not investing in the US. They don't feel, US is the safest asset class like US bonds. And that is now devaluing the US dollar. How do you paint this picture? How is this, devaluing the whole, stock market, your returns in the Nifty, and how this is leading to a rally in gold? And what is your analysis on this?
So I think that part, I think there's a broad consensus around this, that the US debt is now completely out of the whack. It's very, very unsustainable and continues to grow at a very unsustainable pace.
Yes.
Right? $37 odd trillion dollars.
It is right now 37.3.
For an economy of about $29 trillion, we are talking about 125 to 130% of the GDP. Right?
Yeah.
Humongous amount of debt, and this is and continues to go up.
Yeah, especially after 2020.
Yeah, after 2020, it's been completely unhinged, right?
Yes.
And everybody believes, and from the current trajectory, if everything that we discussed a while back, that the labor market continues to weaken, and ultimately at some point in time, if the US were to slip into another recession. So every recession, the playbook is now set. Once the recession kicks in, the Fed has to once again start QE and start printing money, right? And
that will devalue the...
So every round of money printing is, as I said, post 2008, they printed $3.5 trillion. In COVID, they printed $5 trillion. Very likely in the next recession, it will be at least $5 trillion, if not more than that, right?
Sorry, I'm cutting you off, but do you think Trump wants to devalue the dollar deliberately just so he gets away with this debt problem itself? But if he wants to devalue the dollar with that ease, he will need to have new debt. He will need to refinance that money as well, because the US government itself is not running in a fiscal surplus. They are in a deficit. It means they make loss of nearly $2 trillion. Do you think they are, deliberately, or they are at least thinking to devalue the dollar just so they can get away?
So I don't know if he has a deliberate intent or strategy to move towards a weak dollar. I don't think any US president, even if he wanted that, will ever explicitly say that, because US's official policy is to have a strong dollar.
Definitely.
It helps sort of perpetuate US hegemonistic US-led world order. But I think the kind of policies that they are pursuing can leads to a weaker dollar come what may. Because if they really intend on this whole reshoring theme of all essential industries being moved back to the United States, lower dependence on imports, lower dependence on China and India, and more investments and more factories, hard assets to be set in the US. You cannot be a magnet for FDI if your currency is too strong.
Yes.
You need a cheaper dollar, a weaker dollar, if investments from rest of the world has to come into your country to set up factories.
Yes.
Right?
Okay.
For that, you need lower interest rates, and lower interest rates in turn will drive lower currency levels.
Yeah.
So if he is really intent on pushing on this agenda of raising trade barriers, cutting down on imports, and forcing companies to set up more factories in US, these are inherently, by definition, are going to lead to a weaker dollar.
Yeah.
Whether he deliberately wants that or not, but that if his agenda is going to almost certainly lead to a weaker dollar kind of a situation.
But he doesn't want, he won't give this in a speech, yes, I want a weaker dollar.
But I think for us in India,
his policies will
inevitably lead to that, right? But I think for us, what is important is is to look at the implications of a weaker dollar for us here in India, right? I mean, if you are an investor sitting in India, instead of just doing some, indulging in the intellectual exercise of whether the dollar is going to weaken or strengthen, what matters to us is what it means for us here in India, for our economy, and if you're an investor, then for our markets, right?
Yeah.
I believe weaker dollar is a unmitigated plus for emerging markets in general and definitely for India, right? Yes. So the last instance...
But, sorry. Indian rupee is falling more than the US dollar.
Yeah.
Indian rupee is depreciating more than the US dollar.
Yeah.
Why? Is it because disinvestments from around the world from India?
So, see...
or the import-export deficit that we have? What do you want to like...
So I see we are in a situation where near term, as I said, the US labor market is indicating that the US economy is very likely headed into a recession.
Yeah.
Whenever the world's largest economy, which is the backer of the world's reserve currency, is in trouble, history shows us that gradually risk capital starts to move back from riskier geographies to the world's safe haven home, which is USD.
Yep.
Right?
Okay.
So if the world economy is slowing down, if the US economy is slowing down, ultimately we get a recession, and a recession in turn is accompanied by a large stock market crash. That almost always leads to emerging markets going down. Developed markets also go down, but emerging markets go down more. And emerging markets have
because emerging markets are way more volatile, maybe?
They are more volatile. And since they don't have the, US can print US dollars.
Yeah.
It's their own domestic currency. We can't print US dollars, right?
Yes.
So so what typically happens is during times of distress, why do you see economies like Pakistan and Sri Lanka in such distress? Because during distress, they try to print their currency to support their economy. And an emerging market trying to print money means the devaluation is even more accelerated.
Yes.
Right. So during times of global downturn, emerging market, not only the markets go down, even the currencies start to go down.
Yep.
Right. So it's a twin impact of the dollar, the rupee starting to devalue against the dollar, as well as the markets also starting to tank. So I think the rupee starting to come under pressure is more a function of the currency markets starting to foresee that at some point in time there will be a recession in the US, and when there is a recession in the US, there will inevitably be a flight of capital from emerging markets back to US.
Yeah.
And if money leaves India
and goes back to...
It can
be US or even any other asset like...
See, I think there will be many other safe haven assets, but even like it or not, even today, apart from gold,
the only safe asset
safe asset is a US government bond.
Yeah.
Right, which the world still thinks is something which will preserve your capital during a recession. If you have a COVID kind of a scenario where the world is falling apart, nobody knows whether the world is going to see the next year or not. In that kind of a situation, the world is going to come and seek the safe haven status of a US government 10-year bond.
Yeah.
So, and if capital is going to leave India and move back to US, Indian currency will be under pressure.
Yeah.
Right.
Okay.
But coming back to your question of what a weak dollar long term, what are the implications for us here in India?
Also, I just want to add this one more thing in the question. How are these US dollar problems which are going on right now, how are these, which is a weak dollar, and how is the US debt problem, these debt challenges will, affect the emerging markets?
Yeah.
I know you've already answered, but how will they affect India?
Yeah. So effectively, when you have debt which you can't pay, the $37 trillion, and the economy is not producing enough surplus to be able to repay that debt, the only way you can repay that debt is again print more money to repay earlier debt. So you are essentially debasing your own currency. So all this is pointing towards the fact that long term we are talking about a weaker US dollar, right? So let's go back to the last instance where we got a structurally lower US dollar, right? Not the decade, but the period from early 2000s all the way up to 2008, right?
The dollar was weakening like
right.
anything.
So the dollar index, as it is called, the Dixie index, DXY, right? This index dropped from about 120 down to about 80. Right? Right now we are just under 100, about 99.
And I also know it's on a 14-year support right now. The dollar
So we are
index.
just under 100 right now. So I'm talking about between 2000 and 2008, it dropped from 120 to about 80, right? What it did to emerging markets, we had the entire emerging market pack exploding in that first decade of the century, from all the way from
humongous growth.
So this whole acronym of BRICS came because of the growth that we saw in the
2000 to 2008.
So 2000 to 2008, this whole Brazil, India, Russia, China, South Africa grouping just exploded because of a weaker dollar creates so much liquidity for emerging market. Because see, try to think about it this way: if you are an Indian company. A lot of Indian companies try to borrow in US dollars because the rate of interest is lower there, right? Now, if the same dollar in which they have borrowed, if that dollar is now weakening, then at the time of repaying back, it's
pretty good.
It's pretty good for you, right? So a weakening dollar, that's how creates liquidity, gives a huge liquidity boost for emerging markets and emerging market countries.
And that is something very important.
Yeah. So that's the phenomena that will play out. So for liquidity, I am very positive about the fact that if we indeed this whole playbook plays out of a weak dollar, that will give a huge boost to
in liquidity.
And this time round, I'm very confident that the kind of the overall demographic dividend and the spending that we have done on hard infrastructure, that will make India really stand out even within the BRICS pack. The emerging markets in general should do well, but even within emerging markets, I think we will really stand out because the incremental growth opportunity that we have ahead of us because of our low median age and a significantly better infrastructure situation that we have today compared to what we had back in between 2000 and 2008, that will create a significantly bigger push. The liquidity boost that we get as a result of a weaker dollar will create will really make India stand out in the BRICS, even within the BRICS pack.
Okay. Yeah. Okay. So moving on to the next question, the dollar index is on a 14-year support. If it breaks down from here, huge amount of liquidity will hit the market.
Correct.
That is the expectation.
Yeah.
If this liquidity hits, dollar will get devalued. Do you feel, first question, other currencies will get devalued? Second question is, if all of this devaluation happens, every other asset class, like aajkal jo chal raha hai ki every other asset class is at their all-time high. It will continue to go on because the liquidity will actually increase in the market.
Yeah.
So first, will other currencies also get devalued with the dollar itself?
So let's break it up into two parts here. What's the setup that we are looking at near term, and what is likely to play out over rest of the decade, right? For the interest of your viewers, let me start by focusing on what's likely in store in the very near future and where we are in the overall business cycle, right? Yeah. So as we were talking about earlier, let's start to put this all together in terms of what's the implication of all this for Indian markets, especially, right? So the labor market in US is in a very weak spot. New job creation has almost stalled. The unemployment rate has shot up from 3.4% to 4.3%, right? And the trend distinctly continues to look towards the upside. Yeah. And if this were to continue playing out, then we are almost certainly headed into a recession over the next 6 to 12 months, right? Yeah. Difficult to put a timeline, but it's
almost here.
Yeah. So historically, unemployment rate going from 3.4 to 4.3%. That's almost a 1 percentage point jump. that has never happened in the past without the US economy eventually slipping into a recession, right? Yeah. Having said that, if US slipping into a recession, if that's a very high probability event, does that mean that we should sell our portfolio and go and hide in a cave? My unequivocal answer is no.
No.
Because the way this works is as you start heading into a recession, and the Fed can also sense that the US economy is in a weak spot, the Fed is forced to cut Fed funds rate, right, in order to support the US economy and the labor market. So the Fed started its rate cut cycle in September of 2024. Then it went on a pause for almost 9 months, and then it has had to restart the rate cut cycle in September of 2025 because the labor market is in a really, really weak spot, right? Yeah. And it has already indicated there are going to be 2 more rate cuts going forward.
Yes.
Historically, if you look at how the equity markets behave during the course of these rate cuts,
like during the period of liquidity and these rate cuts,
when rates are coming down. Yeah. Now it's slightly counterintuitive, but rates are coming down. Fed is cutting rates because the economy is weakening. Economy weakening is not a good thing for stocks, but near term, rates coming down, at least in the short term, is very good for stock market because
we can expect
because lower interest rates are always lower interest rates mean cost of capital goes down for companies and for consumers. So home loans come down, business loan rates come down, car loan rates come down. So everything, so that gives a liquidity
Even
boost.
in India right now, the markets are not performing that well. But if you look at NASDAQ, if you look at Dow, if you look at S&P.
I was coming to that. So that's why what happens is that as rates start to come down, that kickstart, even though the rates are coming down because the economy is weakening, lower rates pave the way for that last leg of melt up to kickstart in the equity markets.
Okay.
And this melt up goes on all the way till the point the US economy actually slips into a recession.
Yeah. So basically kind of a situation like last rally.
Yeah. So the last leg of the rally.
Yeah.
And this last leg of the rally is usually the most violent part of the rally, right? Okay. So if I were to give you examples going back in history, 2008 we got the worst recession of modern times, right? The recession started in January of 2008. The Fed started cutting interest rates 4 months prior to that, September of 2007.
Yeah.
But in this 4-month period between Fed starting to cut rates in September and the recession starting in January of 2008, in this 4-month period, the Nifty went up by almost 40%.
Which is a pretty good return.
40% in 4 months is almost like 3 years worth of...
Yeah, 2 to 3 years return, right? You've got it easily.
If you consider that Nifty long-term returns have been 12% per annum, you're talking about 3 years worth of gains packed in just 4 months, right?
Yeah.
Pre-COVID was very similar. We got the recession started in January 2020. 5 months prior to that, August 2019, the Fed started to cut rate. As soon as the Fed started to cut rates, we got it kickstarted a rally. That rally was, of course, this time around not as violent as the 2008 pre-crash rally because we got a very sudden onset of the pandemic and that rally was very abruptly cut short. And yet we got a 13% rally within a 5-month period before the recession started, right? Okay. And I believe that we are in that point in the cycle. So
that we can face the last rally.
In the US, that is you mentioned about the NASDAQ and the Dow Jones and the S&P being at all-time highs. This is precisely the phenomena that is playing out. The last leg of the violent melt-up has already started there. We would have got a very similar rally in India as well. Unfortunately, because of the overhang of tariffs that have been imposed on India,
we are not able to see that.
We are not. But think about it this way, that your largest trading partner has imposed 50% tariffs on you, and yet Indian markets have not corrected at all. That's how. Just imagine if this tariff hangover was not there, or going forward, if this tariff hangover gets resolved in the near future, what's the kind of rally that we are talking about?
It's a good rally.
Right?
Yeah.
So that's why I am at this stage, while I'm cautious, the earlier phenomena that I talked about, if we get a disconnect between Fed funds rate coming down and bond yields going up, That could be near-term one risk for the equity markets, but barring that, I am very, very bullish on equity markets. If the tariff situation gets resolved, we will almost certainly join the global rally because we have been,
and that will be the last leg.
That will be the last leg, which will, I believe, at some point in time, sometime between we are probably 6 to 12 months away from the US recession. Difficult to put a timeline, but my hunch is we are 6 to 12 months away from the next recession. So till that recession, we have a pretty good runway, and I'm very optimistic that we will get a resolution of the tariff situation in India prior to that, and that will give the Indian markets also that opportunity for that last melt up before. But once the recession kicks in, then you get you get a very violent crash, slide down. So then you get a crash.
Okay.
Right?
Sorry.
So I am very constructive about the markets at this stage. 2
to 3 questions. Yeah. First, is the recession inevitable?
I let me put it this way. I think it's a very high probability event. Over the next 6 to 12 months, I think it's...
What is the percentage?
I would describe 80-90% probability. In the next 12 months, yes. As I said, unemployment rate going up by almost 1 percentage point. Historically, that has never happened without the US economy ultimately slipping into a recession. So I'll be very surprised if we don't get a recession after this.
Yeah. I say 100%. No, I'm just kidding. What do you think about gold? Rally, because of, obviously, if the dollar weakens, liquidity hits. Equities rally, so does gold.
So I'm very bullish on gold. Yeah. So I don't in equities I have a model where we very frequently churn the portfolio based on our view of markets. In gold, I don't have a model where I can take a bet on the price of gold every month or every quarter. So my view about gold is that I'm very bullish on the overall dynamics that is driving the price of gold. So my view is that if you don't have exposure to gold, try to get a 1 to 2% exposure to gold. If you already have 1 to 2%, try to move to about 5%.
If you have 5%, move to 10%.
I have been 10%. Gold has been about 10% of my portfolio since 2018. So I've been invested in gold for a very long time, and this entire period has not been without pain. So there have been periods when gold during this time has also seen pretty strong downtrends. But again, as I said, for me, that allocation is something that I can only build on. It doesn't matter if gold comes down during this time. And from the kind of rally that we have seen in gold,
the fundamentals are pretty strong.
So from here, it's entirely possible. We could also see a 10-15% drawdown also, though not very likely. But even if it
will be only through profit booking.
Correct. But even if it happens, I believe that will be an opportunity for you to increase your allocation to gold. I am reasonably, I am bullish to the extent that I see gold at 10,000 before the turn of the decade by 2030.
So you say if you have 5, turn to 10. If you have 10, turn to 15.
So I'm not.
I say turn to 100. That's what I say.
So I'm never so absolutist, but I mean. I started.
That's what I did. Sorry, I'm bringing this up. I do if you don't mind.
Please. By all means. I started, as I said, off with about a 10% allocation. Organically, that allocation has now become 15% because the way gold has exploded.
Let's move on to the next question, which is about your SIP.
Sure.
You say AlphaSIPs are way better than your normal conventional SIPs.
Sure.
The first thing we brought this out, the first thing we brought out in the introduction as well, you said this. Why? Why, if I'm a retail investor, why should I go with AlphaSIPs, not with normal conventional? And just to make sure we are, properly doing it in a league. This is not a promotional thing. Not at all. I haven't taken. There's no transaction between us.
So I'm not talking about AlphaSIP or anything. I just want to what I want to explain here is how incorporating liquidity in your SIP can improve the outcome of your SIP. Right? Let me.
Because trust me, guys, I've personally seen what he has done, and I was pretty stunned. I haven't seen a lot of SIPs doing this, and the way he's doing it, I will give it to you, sir. It's pretty marvelous.
Before I explain how you can improve the outcome of a conventional SIP, let me first explain what is it that I see as a flaw in a conventional SIP-based investment approach. right? So unless you define the problem, you cannot come up with a solution. So the problem is, so what I would want to be flashed on the screen right now is this chart which depicts the historical performance of a conventional 5-year SIP in a Nifty. Okay. So this chart basically shows that historically, if you would have invested in the Nifty, if you would have done a SIP in the Nifty for a period of 5 years, then what is the return that you would have got, right?
The best and the worst case.
So what I've done is for every month since January 2010, I have plotted if you did a 5-year SIP, if you did a SIP for the next 5 years.
From this time to this time, this time.
So you start from January 2010 to January 2015. If you did a SIP in the Nifty, you would have got 14.5% return. Feb 2010 to Feb 2015, you would have got 16.64% return. So basically for every month since January 2010, what is the SIP return that you would have got had you done a 5-year SIP in the Nifty over the next 5 years? So if you do this exercise, then you can basically find out what has been the best case, worst case, and median case outcome of a 5-year SIP in the Nifty. So it turns out since 2010, best case return has been 20.35%, which you would have got this return had you done a SIP between October 2019 and October 2024.
Okay, this is the best case scenario.
After 2010, if you go back further, if you go back further,
obviously
the best to November 2002 to November 2007 has been the best case of a Nifty 5
in
year.
history.
So that's 45%.
45% per year.
Per year, right?
Oh
so,
my God. Okay.
But the common and we need to understand why did that happen. October 2019 to October 2024, right? Your 5-year SIP ended close to that market peak of September 2024.
Yes.
Right?
Yeah.
So if your 5-year SIP coincides with a period where it culminates into a new all-time high, that means you've got a pretty nice upswing during your 5-year SIP.
Yeah.
So same thing happened in November 2007 to November 2000. The earlier instance that I said, November 2002 to November 2007, where you got the 45% return. Why? Because your 5-year SIP ended in November 2007, just at the market peak before the 2008 ka crash, right?
Yeah.
So if your SIP is ending at a market peak, you get these 20, 30, 40% kind of
the
return.
Best case scenario.
Best case scenario, right?
Worst case. Whatever they are.
So as you can see in the chart that I'm showing, worst case return April 2015 to April 2020. Your return of a 5-year SIP was negative 5.82%, almost negative
6% per year.
Per year, right?
Yeah.
That's horrible.
That is almost like
that's
killing
horrible.
your money.
That's killing your money. Right?
Yeah.
Why did this happen? Because your 5-year SIP ended in the middle of the COVID pandemic.
Yes.
Right?
Yeah, when the true bottom hit.
Happened.
Yeah.
So your 5-year returns are basically wiped off.
Yeah.
Right? So the range of return is quite wild, right? Yeah. Negative 6% to positive 20.35%.
Yeah, these are conventional basic.
Conventional 5-year SIP, right? Average is about this 12-13. Everybody assumes that you do a FD, you get 7 to 8%. You do a SIP, you get 12 to 13%, right?
Yeah.
But this 12 to 13% is actually the average. The average is not what is likely to accrue to you. What is likely to accrue to you is depending on how market conditions are going to be over the next 5 years.
Yeah.
So we are right now in October of 2025. You do let's say if you have a life goal over the next 5 years, you start doing a SIP up to October of 2030. So let's say, for example, the example that I love to cite, if this is the outcome profile of a conventional 5-year SIP. At the end of 5 years, you can end up with negative 6%. You can end up with positive 20% or 45%.
And in the middle, like 5, 7, 8.
Kuch bhi ho sakta hai, right? Yeah. Now, let's say if you have a life goal, आपके घर में आपका बेटा है, he is in class 7. 5 years later, he's going to finish class 12 and go to college. You want to build a corpus to pay for his college fees. You want to build a corpus of whatever, let's say 20-25 lakhs for his engineering college or medical college, wherever you want to send him, right? तो आप क्या करोगे कि यू विल गो टू ए फाइनेंशियल एडवाइजर, उसको बोलोगे कि आप मुझे 5 साल बाद आई नीड 25 lakhs,
ये रहे मेरे पैसे, दिस इज माय मनी, ग्रो दिस अप.
So he will do a back calculation कि markets का long term return has been 12%. तो 12% का return मिला तो what is the per month SIP that I have to do over the next 5 years to get to 25 lakhs.
Yeah.
So based on that, he will tell you that amount and you start doing a SIP of that amount.
Yeah.
The underlying assumption there is that over the next 5 years, I will get 12% or more than 12%.
Yeah.
Right?
Got it.
The probability of getting this 12% is actually pretty low. Okay. To be precise, the historical probability of getting 12% from a 5-year SIP in the Nifty historically has been only 53%.
Okay.
ये 53% आया कैसे? ये जो चार्ट हमने आपको स्क्रीन पे दिखाया है, you can see January 2010 से अभी तक there have been 124 months.
Yeah.
For each of these months,
you guys calculated a 5-year.
अगले 5 साल का 5-year SIP
yeah.
return क्या था वो हमने निकाल लिया.
Yeah.
Turns out that out of these 124 months, there have been only 66 months जिसमें 5-year SIP का return 12% या उससे ज़्यादा था.
Okay.
66 out of 124 turns out to be a probability of 53%.
Okay.
To put this in context, when you toss a coin, the probability that your guess is going to be right, that probability is only 50%.
Yeah.
Right? So you are only 3 percentage points higher than the probability of getting a coin toss right.
Yeah.
Right? And you are so the probability you are your life goal is I want to save up 20-25 lakhs for my child's college education,
yeah.
for which I am betting that my next 5 years my SIP will get me 12% return. But your SIP will get you 12% return, 12% or more. Iski historical probability is only 53%.
Yeah.
I ask you, if you were to be in that father's shoes,
Not at all.
Will you be comfortable
Not at all.
betting such a critical life goal on something whose historical probability of achieving, of that life goal being achieved is only 53%? It's not, right?
So sorry, I'm cutting this off, but how do you come as a solution?
So this is the solution that we are trying to solve for our customers. We are not trying to generate 20, 25, 30% return for our customers. In fact, most of our customers, that's why are slightly not millennials. These are people who are...
You're not giving them fake return, like fake hope.
My proposition to my customer is, I will help you get between 12 to 15% return, but with Nifty's track record of a conventional SIP in the Nifty.
Yeah.
Nifty gets you 12% return with a probability of 53%. A good mutual fund will increase that probability to about 60%. But for me, I need at least 80-90% probability for it to be a very strong probability event. Yeah. Right?
So
what we try to do is to push up the probability. My goal is not to increase the expected return. My goal is increase the probability of 12 to 15% return to a 90% probability.
Okay.
Right?
Okay.
Now, how do you do that?
Yes.
Right? So how do you do that? And for me, the way to do that is everything that a financial advisor will ask you never to do, which is everybody tells you, don't try to time the market. Right?
Yep.
And at the heart of what we do is everything that I said, so that it doesn't become just a theoretical exercise, we try to bring this to bear in the form of AlphaSIP that we offer to our clients. Yeah. So at the end of the day, we believe that financial markets are a function of the prevailing liquidity condition. If liquidity conditions, if Fed is printing money, if the Fed has pumped the financial system with a lot of liquidity, all asset classes, including equities, will do very well. And during times we saw that early 2022, Fed started to increase interest rates. It stopped money printing, and asset markets had a pretty bad time.
Yeah.
Right? So if liquidity conditions are not good, markets will correct. Those are times when you should not be in stocks. When liquidity conditions are good, you should be in stocks.
Yes.
Right?
Yeah.
I'll give you a sort of for the benefit of your audience, I'll set the context here. Not the entire AlphaSIP strategy, but just to give you
the basic.
Give you a flavor of how a liquidity-linked market timing approach can phenomenally improve the outcome of a conventional 5-year SIP. There is this another bond market parameter that we track very closely. It's a US bond market parameter.
And that is something very, very important, I guess, You should tell the viewer as well.
Yeah.
How important it is.
Correct. So this is so this parameter is called Jung bond spread.
Yeah.
Right.
Okay.
So sounds complicated. It's not. So I'll explain in very simple terms how it works. A bond is basically a debt instrument. If you invest, so there are bonds issued by the government, there are bonds issued by private companies.
Yeah.
If you invest in a government bond, you are essentially given a loan to the government. If you are invested in a private company's bond,
you're giving loan to the
giving a
private
loan to the
company.
private company.
Yes.
Right. Now the interest, and when you give a loan, you get interest from whoever you have lent the money to. Right. Now the interest rate that you get by investing in a bond is a function of the risk of default of that bond.
Okay.
The safer the bond, lower is the interest rate.
Yes,
right?
definitely.
Higher is the risk of default, higher is the interest rate, because you need a higher interest rate to compensate for the risk of default.
Because if I'm coming to you and I have a lot of debt problems with me, you will obviously say I want higher interest.
I will demand a higher interest.
Yeah, and I will say if the market rate is 8, I will give you a 10.
Absolutely. Two people having, one person with a high CIBIL score, someone with a lower CIBIL score, the guy with a higher CIBIL score gets a lower interest rate.
So that difference is a spread, or
no? So this is not spread. Now when it comes to the risk of default, the lowest risk of default is with a government bond.
Yes.
Because government technically can never default. Even if it runs out of money, technically it can print money and return your money.
Yes.
Right? So since government bonds are the safest, so the interest rate that you can get by investing in a government bond is also the lowest.
Okay.
Right? A private company's bond has risk of default because a private company can technically go bankrupt.
Yes.
You invest
100%.
in a company's bond, the company goes bankrupt, you never get back your money.
Yeah.
Right? So since there is a higher risk of default, the interest rate that you get that an investor will demand for investing in a private company's bond will be higher than the interest rate that you get by investing in a government bond.
Yeah.
So the spread basically means how much additional interest rate the investor demands compared to a government bond's interest rate to invest in your bond.
Okay.
If
for an example, it can be said like this: if I am coming to you and you're asking for 10%, that is a difference of 2%.
Yeah.
If I go to another person after 6 months, it's 3%. So that is like the additional amount.
No, the difference between investing in your bond and investing in a government bond.
Yeah.
Government bond.
But now I was just setting an example. Like
so if right now
if the market rate is 8, which is like the government bond, and your
so market rate mein you have to be specific. I'm talking about the government bond. So right now
I was using an analogy. That's why
fair. But in a US government bond context, if US government 10-year bond rates are currently at 4.2%, a private company's bond is at a yield of 6%. The spread is 6 minus 4.2.
Yeah.
So which is 1.8 is the spread.
Got it.
Now, even within private companies, there is a whole spectrum. Right?
Yes.
There are
AAA companies.
There are AAA companies which
are
like
the safest.
Which are even within India, right? The Tatas and the Birlas and the Adanis and the Ambanis of the world, which have a long track record of not having defaulted on their loan.
They never defaulted.
So within the private sector pack, their interest rates will be the lowest. And then there are lower rated companies, which are smaller companies where the risk of default progressively keeps on increasing. So from AAA, you come to AA, single A, triple B, double B, single B, triple C, double C, single C. As you go down to these single B, triple C kind of companies, so these are companies where the risk of default is significantly high.
Which are complete junk.
So they are in US parlance pejoratively referred to as
junk.
So their bonds are referred to as junk bonds, right?
And definitely not calling the company junk.
So in there, and the spread, and so the difference between their yield and the government bond yield is what is called junk bond spread. Compared to a government, if the government bond is at 4.2% and your yield is at, let's say, 8%, so the spread is 3.8%, right? So that's the... Now,
so here is the chart.
So now the chart that you see, the red line basically represents the junk bond spread, right? Now,
the blue line is?
And the blue line is the Nifty. Right?
Okay.
Now, the first thing that I want you to appreciate is that these two lines are almost mirror images of each other.
Okay.
When the red line is going up, the Nifty is coming down.
Okay.
Right?
So it means whenever the red line goes up, the blue line goes down, like Nifty goes down. Whenever the
red line is coming down, the Nifty experiences rallies, right?
Okay.
Think about it intuitively, it will make sense. Spread going up means interest rates going up.
Yeah.
a company having to pay very high interest rate on its bond means liquidity conditions are now very tight. Money is not easily available. That's why the company is having to pay a very high interest rate.
Because if nobody is lending me, I will go to somebody and say, give me at 15%.
15%.
If the market rate is at 10%, I will say 15, 20. I will just take it. I need money to survive.
But whereas in an economy which is flush with liquidity, you will very easily be able to borrow the money. So you don't have to offer a very high interest rates, right? So during such time, the spreads are lower. So that's why when interest rates are high, that happens during times of financial distress.
Okay.
And that's why they also coincide with times when the blue line, which is the Nifty, which corrects. Right?
Okay.
In fact, I have also indicated the two vertical lines which represent periods when the US economy slipped into a recession. So historically, whenever this red line, the junk bond spread, whenever it has gone above 7%, historically we have always got a recession in the US.
And right now, where is it?
So it's very low. Right now it's below 3%. I think the last reading was 2.72.
Okay.
Right?
Okay.
So we are very comfortable. So liquidity is pretty good. So this again correlates to what I said earlier, that we are in the run-up to that recession where the stock market usually does well.
Okay.
Right? So this is why this helps us get out of the markets before finally that recession kicks in. Right. So what this chart shows is that in this chart you can very clearly see that in the run up to a recession, this red line starts to go up. So this is a very reliable leading indicator that a recession is coming. So historically, whenever it has gone, when the trade war situation first was triggered in April of this year, that's the time when the junk bond spread went up to about 5%. It's not very high by historical standard, but
it was near the recession.
That's the highest that we have got in the last 4 to 5 years.
Okay.
So we became very cautious. But as soon as it hit 5, and then it started to come down, and and based on that, we could very quickly conclude that this is not something that is going to push the economy into a recession. Right? But if it consistently would have continued to go up, that would have been a very, very reliable recession.
This is what you guys actually look into.
So this is one of the parameters through which we track liquidity. So there are AlphaSIP, we look at total 15 plus bond market parameters like junk bond spread. Right? Now, for now, let's just focus on junk bond spread and see how can we improve the outcome of a 5-year SIP.
Yeah. Right? How are your results?
Right. So I'll come. So everything we will talk in terms of very hard numbers. Now, from this we can make a very common sense strategy. Whenever the red line shoots up, you should not be in equities. You should move to something like a liquid fund or a debt fund. Safe asset.
Yes.
Right. So here's what I am proposing a strategy. Right. So the strategy that
according to this strategy, how is the SIP?
So this is the strategy that I'll propose. We can have this on the graph.
Yeah.
Every month on the first trading day, we should look at where is the junk bond spread right now on the first trading day of every month. Then we should look at where was the junk bond spread on the first trading day of the previous month.
Okay.
Right. So let's say in the coming month, on first.
So 1st of April, 1st of May, 1st of.
Correct. So it first trading day, whichever is the first. So your
basic like in
whatever. If your first trading day is a weekend, then second or look at third or whatever is the first trading day. So we are, let's say right now we are shooting this in October of 2025. So the next first trading day we will get is whatever is the first trading day of November. On the first trading day of November, we will look at what is the prevailing junk bond spread. Okay. Then we will look at what was the junk bond spread on the first trading day of the previous month, which is October of 2025.
Okay.
Got it. Another nuance, when I say what on 1st of November, what is the current junk bond spread? I don't take the exact junk bond spread on that day. I take an average of the previous 30 days.
Okay.
And then when I look at the junk bond spread on the first trading day of the previous month, which is 1st of October, On 1st of October also, I look at the average of the previous 30 days from 1st of October.
Just so you can compare it.
So
Just so you can compare it.
एक single day में बहुत noise होता है. Average लेने से थोड़ा सा
एक पता लग जाता है.
Even out हो जाता है. Right? So you have two junk bond spreads.
Yeah.
This month का, previous month का.
Okay.
Now you calculate कि इस महीने से इस महीने, over the last 1 month, what has been the growth in junk bond spread? By how much percent has the junk bond spread gone up, gone down, or has remained flat?
This is your main forte.
So I'm just laying out a strategy that I'm not trying. So as
I said, no, I get it. But I'm asking you normally.
You can follow it with your own SIP.
Yeah.
Right.
You don't have asking normally with your thing, your analysis. Remove the SIP part. This is like your main forte. This is how you analyze.
Correct. So now you are looking at. हमें क्या देखना है? We need to look for periods when this red line has shot up.
Yep.
During such times हमें equity से निकल जाना है.
Which has been usually before like 2008, 2020.
Correct. तो हमें अगला. So what we will do is that every month first trading day junk bond spread हमने देखा. Previous month के first trading day का junk bond spread देखा. We then compare by what percent this junk bond spread has gone up or gone down over the last 1 month.
Yep,
right?
Perfect.
If it has gone up by a very sharply, that means
something is up.
Red line is going up. अभी निकल जाना है. Right? तो as you can see on the screen, दो conditions हम check करते हैं. Current junk bond spread should be above 3.75 and the month-on-month growth. पिछले last month से इस month, the junk bond spread should have gone up by 5% or more than 5%.
Yeah. All right.
Right? A 5% month-on-month growth means a very big spike.
Yeah.
If that has happened, then for the coming month, move the entire portfolio to a liquid fund.
Yeah.
Only for that month.
Safe assets.
Safe
like
asset.
That. Okay.
Do this and do this exercise every month.
Yeah.
फिर 1st of December को फिर से देखो. If junk bond spreads have started to come down, then go back to equity.
Okay.
If junk bond spreads continue to meet this condition, 5% month-on-month growth, then continue to stay in debt.
Okay.
So do a 5-year SIP like you would normally do. Every month you are putting money. 5-year SIP means 60 months. Every month you are putting whatever is the SIP amount, 10,000, 20,000, आप डाल रहे हो. बीच में सिर्फ आपको ये करना है कि in whichever month you see these two conditions being met. Junk bond spread on the first trading day of that month is more than 3.75% and the month-on-month increase is more than 5%.
5%. Yeah.
For that month, move to a debt fund.
Okay.
If these two conditions are met, then you move to a debt fund. This is the only difference between a conventional SIP and a junk bond spread linked SIP.
Okay.
Right?
You're not giving it your name.
हाँ. I'm not. ये आप खुद भी कर सकते हैं. Right?
Okay.
Junk bond spread का ये it's a publicly available variable. Fed के website में मिलता है. We'll put the link of आप कहाँ से ये data मिलेगा. ये हम दे देंगे आपको. Right?
Now show me the results.
Let's look at the results.
Yeah.
Right? ये अगर आप करते हैं normal SIP का, so this is the outcome that you see on your screen right now. Conventional SIP का worst case we saw negative 5.82, negative 6 positive, and best case is positive 20.35.
Yep.
Median outcome, which median is like another variation of average, is 12.45. 12.5.
12.5.
ठीक है. अब ये जो मेरा junk bond spread linked है.
Yeah.
Worst case improves from negative 6 to take a guess.
6, 7. I don't know.
Positive 7.8. 8.26.
Okay.
Right?
Yeah.
This is worst case.
Yeah.
I'm not saying so. All the caveats are there. This is not a guarantee that this trend will hold up in future as well. But for whatever this historical,
this is your backtesting.
The historical backtesting is worth.
Yeah.
But this is powerful in my view.
Yeah.
That normal SIP during times when markets go down, your 5-year SIP returns can be negative 6%. But if you follow this strategy, which you can follow yourself based on a publicly available variable, worst case is positive 8.26. Best case is 25.93, almost 26%.
26%.
Best case we improve karke.
And it has moved these returns.
And the median case also has improved from 12.45. It has become 14.68. That has also improved by 2 percentage points. That
is incredible.
So just try to think about it this way. Your worst case is now more than FD. So market नहीं भी चला, तो भी मुझे FD से better मिल रहा है. Your downside is protected, and at the same time you still get a upshot at the upside. अगर market चला तो you can get up to 25%.
Yes.
Right? Best of both worlds.
So this is like actually mixing up the whole thing.
Correct.
And
So this
actually
is
timing it.
And this is what you get by through just one variable. अभी सिर्फ junk bond spread एक variable से इतना ड्रामेटिक इंप्रूवमेंट. तो हम लोग वही AlphaSIP में हम लोग बेसिकली ऑलमोस्ट 15 वेरिएबल्स यूज करते हैं. तो ये जो वर्स्ट केस 18 है, इसको हम लोग इसी से कोशिश करते हैं कि ऑलमोस्ट 15 तक ले जाए.
वर्स्ट केस.
So again, this is not, I will repeat, this is not an commitment कि worst case आपको going forward be 15.
But you try your best.
But this is historical backtesting of the strategy which can be verified through publicly available variables. It can, when you apply all the 15 plus variables that are part of our AlphaSIP logic, the worst case goes up to almost 15, 16, 17 kind of a number. Okay. Right?
That's good.
Yeah. Thank you. So this is what we try to achieve. So, and this is what incorporating liquidity. My point is not to sell you AlphaSIP. The important thing that I want to take away from this discussion is have a view of liquidity. Figure out a
learn about macro as well. Like
learn about macro. So this just conventional SIP, passively investing, just averaging karte raho. It's good. But if you don't bring in this flavor of how liquidity impacts equity markets, then it will, as I said, it will have a bearing on your SIP. Agar आप 5 साल, if your 5-year SIP,
you can't be just, sorry I'm cutting you off, but you can't be just कि आपने SIP कर लिया and you can't just, ऐसे नहीं कि आपने SIP कर लिया, you can't just sit away and just normally.
And especially if your SIP at the end of 5 years is tied to a financial goal, then a SIP can have very disastrous consequence. Think about a 5-year SIP किसी ने किया and that SIP is for funding the college education of his child. Imagine somebody who did this SIP who started this SIP in April of 2015. उस समय he had no clue that 5 years later when his child is about to go to college,
his money is minus 6%.
He will, at the end of 5-year SIP, the world will be in the middle of the worst pandemic in recorded history, and 5-year SIP outcome is negative 6%. Now the counter to that most advisors will give you is कि आपका नेगेटिव है तो आप एक
और
साल
डालो
और एक तो और या तो और डालो और या तो सर 1-2 साल और रुक जाओ, मार्केट्स रिवाइव भी करेंगे. बट माय पॉइंट इज नॉट
जब आपको चाहिए वैसे
नॉट एवरी फाइनेंशियल गोल गिव्स यू अफोर्ड्स यू द फ्लेक्सिबिलिटी ऑफ एक्सटेंडिंग द टाइमलाइन. आपको आप कॉलेज एजुकेशन के लिए वो पैसा 2020 में चाहिए तो 2020 में. यू कैन नॉट गो टू द कॉलेज की मैंने SIP करके पैसे जोड़ रहे थे और मार्केट बंद हो गया है तो आई नीड 2 more years to pay the money. So during, if your goal is of that nature that I need in 5 years from now I need so much money, and to achieve my goal I need at least 12% return, you have to have a flavor of liquidity in your investing philosophy.
So a few rapid fire questions I have because we are running.
They're the toughest.
Not the toughest because it's like more about it's more about like Indian GDP, like Indian markets, and analysts who are 24/7 bullish on Indian market. So the first question. Let's come on to the India's GDP and asset classes. First, let's talk about the stock market. Do you think the Indian stock market is undervalued, fairly valued, or overvalued? Through the lens through which I look at markets, there is no such thing as overvalued. Markets find their own level based on the prevailing liquidity conditions. Okay. If right now, if liquidity conditions globally, as I said, Fed is cutting rates, that gives a great liquidity boost. That's good for stocks. Stock markets will go up. Right now, liquidity conditions globally are very good. India is not being able to catch up to that. Not being able to take benefit of that because of the overhang of tariffs. But I think that will correct itself in the next couple of months. And we should also join the global party. In last 1 year, I've seen many analysts. I don't want to take any name. Analyst companies. I'm pretty sure you also know who I'm talking about. But many analyst companies saying Nifty's target is way more than what it is right now. A lot of stock targets. I vividly remember that when Tata Motors was at 1,050, one analyst company gave an analysis that it will go to 1,300. I'm pretty much, I'm sure one gave it. What do you think about these analysts who are 24/7 bullish on Indian market? I'm not saying it's a bad thing or a good thing. It's not about that. But it's about, do you think they're underpricing or like misguiding retail investors? Would you say like...
So see, you have to make a distinction. If your bullishness about the Indian markets is a sort of a structural view about Indian markets doing well in the long term, that's not a problem. It becomes a problem when it becomes a sort of a financial advice to be followed in the near term. That irrespective of what
you
market
put
condition,
money in 3 months, you're gonna get it doubled.
So that's where I believe that you have to have a view on liquidity. If liquidity conditions are good, by all means be bullish. And historically, 70% of the time, liquidity conditions usually are good. It's only during 25-35% of the time when liquidity conditions tend to dry up, and during such times you have to be cautious. But it's important that during such times, the drawdowns can be so severe that if you are a perma bull, you will hurt yourself.
I guess when you have to make money in the market, you have to change your sides.
Correct.
Time to time.
The problematic part, as you said, most of these perma bulls are those during the rising market, they will advise retail investors that markets are going up, you're missing out on the party. And when the markets are going down, they're like, where the stocks are cheaper, you should invest. So it can't cut both ways, right? You need to have some sane logic
definitely.
to your advice. So
you know what the funny thing is? My next question in my questionnaire was, do you think we can see a short rally in US equities and Indian equities before there is a boom bust scenario? I had this question because to
a certain extent, I think I answered that. So I strongly believe, just to reiterate what I said, that the Fed, we are right now, the US economy is weakening, and in order to support a weakening US economy, the Fed has restarted its rate cut cycle. Rate cut cycle usually kickstarts historically speaking, has always paved the way for that last leg of the melt up to start off. And I think that's what is exactly playing out globally. All the US indices are now at all-time highs. We would also have been there had it not been for the overhang of tariffs. But I continue to remain bullish and optimistic that at some point in time, hopefully, we will get a resolution of the tariff situation, and our markets should also join the global party. So, but it's not I'm not talking about a multi-year bull run. I'm talking about rate cuts being bullish for markets up to the point the US finally slips into a recession. After the US economy slips into a recession, which I think the US economy will at some point in time in the
every other emerging market.
So in the next 6 to 12 months, after that, we are in for a very, very nasty crash.
Second last question. Looking beyond all the things you have talked, is there any one sector or one stock, just not a stock, just tell me one sector you feel is very good for next 10 years? Just one sector, if you have anything in mind. There are EV, solar panels, chip sectors, AI and everything. What is one sector?
So I follow liquidity. Okay, so I'm not a stock picker.
Okay,
if liquidity conditions are good, I can tell you that this is a good time for equity as an asset class. I don't, within equity pack,
you don't go into...
But having said that, I will try to give you an answer to the extent it's part of my research. We are in a world where structurally the US and most leading central banks will have to print their way out of the debt crisis that they have dug themselves into, right? The amount of debt that the US, this $36-37 trillion can be repaid only by new money creation, that new money being printed to pay off the older debt, right? When you create fiat currency at this rate, you're debasing the fiat currency, right?
True.
When you debase fiat currency, it leads to appreciation of hard assets which cannot be printed, which are in finite supply. And that's why you see the rally in gold, silver, etc. Right? This theme, if you extend this, will also extend to anything which is commodity in nature. Base metals, precious metals. So and a leverage play on the price of commodities, on price of gold is companies which are involved in the mining
of that gold.
Mining of gold. We don't have listed gold mining companies, but we have listed base metals company in our. So we have a metals index, right? So we have companies which make steel, company which make copper.
The last question for this podcast, the closing question. What is that one core piece of knowledge? What is that one mindset shift that actually helped you to, not turn even profitable, to actually look at markets pretty differently? How were you able to, catch this junk spread of, junk bonds, bond market, bond yields, junk bond spreads? How were you able to catch all these things? What made your mind shift, and, how were you able to realize all these things?
So the answer is liquidity.
Okay.
Right?
Okay.
What helps you? What is the edge that you have? Which
was it like? Sorry, I'm cutting you. Was it like you one day thought like, how is it possible that money is rushed with liquid money, and how is it sometimes not at all available with any money? Was that the question that drove you towards thinking that?
So as I said, it's again I go back to the time when I graduated out of my business school.
Yeah.
In the middle of the entire 2008-2009 crash, and by the time this thing had played out, and I had the benefit of seeing this at a time when I was actually studying about this in college as well, right? So I could in a way have a very sort of a theoretical appreciation also of getting to actually see things play out, of things that you are actually studying in school. And what was very clear to me is that some of the largest moves that you see in our markets are actually driven by global events. Right? And global,
be it India, be it SGX.
Correct. So if you have a very narrow view of Indian market, looking at Indian markets only through the lens of what is our GDP growth or what is our inflation. If you're only going to look at Indian markets through the narrow prism of what is the earnings growth of Indian companies, what is the GDP growth of our country, then you are going to miss out on this, this monster in the room that of how global liquidity impacts our markets. And the reality is that the largest moves in our markets, both on the downside as well as on the upside, have been caused by changes in global liquidity condition. As I said, the largest crash in India has been the crash of 2008. We got a 60% correction. That happened because of the subprime crisis and the Lehman Brothers going bust. And the most dramatic revival in our stock market is the post-COVID rebound that we saw from 23rd March 2020 onwards.
So what we learned from this whole podcast is, first, liquidity. That is one of the most important things for not only normal investor, but for retail investor as well. Bond yields, junk bonds, be it any kind of bonds, these kind of things do affect the whole equity markets as well. And coming out with the last thing, the recession is inevitable.
I think so.
Perfect. Thank you so much, sir. It was a pleasure to have you. It was a great podcast. Thank you so much. And hope you are back with the hedge fund that you have talked about. Thank you so much,
Thank you for having me.
Perfect.
Pleasure.